Harold bought a timeshare in Maui in 2012. He thought he was being clever. Locked in vacation, costs before inflation, ate everything, owned a piece of paradise, guaranteed memories for the family. Last year, he paid more in maintenance fees and special assessments than a week at the Ritz-Carlton would have cost him outright. He's tried to sell it twice. The resale market offered him $900 for something he originally paid $19,000 for. He declined both offers out of spite. Now he's sitting on a liability he can't give away, watching the annual fees climb faster than his Social Security cost of living adjustments. Doris retired with a pension and Social Security that covered her basic needs. Not luxury, but comfortable. Her financial advisor convinced her to put $200,000 from her 401k into a variable annuity with an income rider. Guaranteed income for life, he said. Never run out of money. What he didn't emphasize was the 7-year surrender period, the annual fees, stacked on fees, and the fact that her pension and Social Security already covered her floor. She didn't need guaranteed income. She needed growth. When her husband needed an unexpected surgery and they wanted access to that money, the surrender charge was $17,000. The advisor who sold her the annuity had already spent his commission. Richard bought a whole life insurance policy at age 58. The illustrations showed cash value building steadily, a supplemental retirement fund he could tap tax-free. By year 6, he'd paid in $42,000 in premiums. The cash value was $11,000. The agent showed him projections assuming continued premiums for another 15 years before the policy would actually be worth discussing as an asset. Richard will be 73. The guaranteed income he was sold looks different when you calculate the time value of that money. Linda owned a rental property in California while living in Texas. $550,000 in equity, she'd tell people at dinner parties. A real asset, something solid. Her net income, after property taxes, insurance, property management fees, and setting aside money for the inevitable repairs, about $15,000 a year, that's a 2.7% return on her equity, with phone calls about broken water heaters and tenant disputes baked in. What do these people have in common, besides regret? They all thought they were buying assets. They were buying anchors. I'm Tom. I read the boring documents so you don't have to. SEC filings, tax code sections nobody else touches, the fine print on financial products designed to transfer your wealth to someone else. And today, we're covering 8 assets that wealthy retirees almost never touch, and that less wealthy retirees seem magnetically drawn toward. This isn't about how much you saved. It's about what you did with it after you saved it. The difference between a comfortable retirement and a stressed one often comes down to which side of these 8 assets you landed on. Quick note, before we get into it, I built an early retirement calculator that runs these exact scenarios comparing different asset allocations and their actual long-term costs. It's free, it's on my site, and it'll show you exactly what these 8 assets are costing you in real dollars. No email required, use it after you watch this. Here's the framework that matters. Retirement isn't about how much water you pour into the bucket. It's about how many holes you drill into the bottom. You can save aggressively for 30 years, max out every tax advantage account, hit your number, and then drill 4 or 5 holes in that bucket through assets that drain you slowly. The water level falls anyway. Most retirement advice focuses exclusively on the filling part. Contribute more, earn more, save earlier, all valid. But I've seen people with 7-figure portfolios struggling in retirement because they loaded up on products designed to benefit the seller, not the holder. The leaky bucket metaphor is going to come back throughout this video because it's the most honest way to think about retirement planning. Let's start with asset number 1, timeshares. The classic, Marcus and Janet went to a presentation in Phoenix in 2015. Free weekend at a resort, no obligation, just listen to a 90-minute talk about vacation ownership. They left 3 hours later as the proud owners of a deeded week at a property they'd never heard of before that day. $15,000 upfront, financing available, maintenance fees of $800 annually that the salesperson promised would basically never increase. The math looked simple at the time. $15,000 divided by 20 years of vacations was $750 per year for a week at a resort. Seemed reasonable. But the sales presentation didn't mention special assessments. When the resort needed a new roof in 2019, every owner was hit with a $2,300 bill. When they renovated the pool area in 2022, another $1,800. The maintenance fee that started at $800 is now $1,100 annually and rising about 4 to 6% per year. The salesperson's promise about fees not increasing was charitably inaccurate. Marcus and Janet have tried to sell. They listed on a timeshare resale site. The highest offer they received was $1,200, roughly 8% of what they paid. They've since learned that the resale market for timeshares is flooded with people trying to exit the same trap. Supply vastly exceeds demand because, and this is crucial, timeshares are not real estate investments. They're prepaid vacation contracts with escalating obligations. Here's the ugly arithmetic. Over 20 years, Marcus and Janet will pay roughly $30,000 in maintenance fees at current trajectory. And that's assuming special assessments stay minimal, which they won't. Add the $15,000 purchase price and the special assessments they've already paid, and they're north of $50,000 for 20 weeks of vacation. That's $2,500 per week. For a property they don't control, can't easily sell, and feel obligated to use because they're paying for it whether they show up or not. The psychological trap here is what I call commitment to memories. Marcus and Janet aren't buying a vacation week. They're buying the feeling that they've secured future happiness for their family. They're prepaying for memories that haven't happened yet. That emotional framing makes the math irrelevant during the sales pitch. By the time the numbers become clear, they're locked in. Wealthy retirees don't buy timeshares. They rent exactly the vacation they want, when they want it, at the property they choose, with zero ongoing obligation. They keep that $15,000 or more realistically, that $40,000 or $60,000 in the case of points, systems invested. At a conservative 5% return, $60,000 generates $3,000 per year. That pays for a very nice week somewhere, and you still have the $60,000. The difference isn't just financial, it's flexibility. Timeshares lock you into a system. Wealthy retirees buy options, not obligations. Asset number 2, high-fee annuities. Patricia worked for a school district for 31 years, retired with a pension of $47,000 annually, added Social Security of $22,000. That's $69,000 of guaranteed income before she touches any savings. Her basic expenses were $52,000. She wasn't rich, but she was secure. Her financial advisor looked at the situation and recommended she put $200,000 from her 401k into a variable annuity with a guaranteed lifetime income rider. The pitch was simple. You'll never run out of money. Guaranteed income for life. Sleep well at night. Patricia didn't need more guaranteed income. She had a floor already covered. What she needed was growth, the ability for her remaining assets to compound so she could handle healthcare costs later, leave something to her grandchildren, travel occasionally, the annuity guaranteed income she already had, while capping her upside and charging her handsomely for the privilege. The annuity carried a mortality and expense risk charge of 1.25% annually. The income rider cost another 0.15%. The underlying investments were mutual funds with average expense ratios of 0.95%. Total annual drag, roughly 2.35% before you factor in the opportunity cost of not being in lower cost investments. There's also the small matter of surrender charges. Patricia's annuity had a 7-year surrender schedule, starting at 9% and declining by 1 percentage point each year. In year 2, when her husband needed dental work that insurance wouldn't fully cover, she wanted to pull out $20,000. The surrender charge alone was $1,800. Plus, the withdrawal reduced her guaranteed income base, the very thing the annuity was supposed to protect. The advisor who sold this to Patricia earned a commission of roughly 5 to 6% on the $200,000 premium. That's $10,000 to $12,000, paid upfront from a product that locks the client in for 7 years. The incentives are not aligned. The advisor got paid immediately. Patricia got a product that made sense for the advisor's revenue, not her financial situation. I want to do a quick cutaway here. Imagine this conversation. Patricia, I need to access some of my money. Advisor, well, you absolutely can. It's your money. Patricia, great. I'd like to withdraw $20,000. Advisor, perfect. Now, there is a surrender charge of $1,800, and this will permanently reduce your guaranteed income base by about $1,100 annually. Also, if you withdraw more than your free withdrawal amount, which is 10% of your contract value, it could trigger additional fees. And just so you know, any withdrawals are taxed as ordinary income to the extent of gains. And if you're under 59.5, there's a 10% early withdrawal penalty. Patricia, you said it was my money. Advisor, it is. It's just your money with conditions. Annuities aren't inherently evil. There are situations where they make sense, typically when someone has no other guaranteed income beyond Social Security and needs to create a floor they can't outlive. But they're oversold to people who don't need them, structured in ways that maximize commissions and lockups, and marketed with guarantees that hide the real costs. Wealthy retirees tend to have their guaranteed income needs met through a combination of Social Security optimization, pensions where available, and sometimes low-cost immediate annuities or single premium products without all the bells and whistles. They don't buy complex, high-fee products from advisors whose compensation depends on selling them. Asset number 3, whole life insurance sold as a retirement vehicle. Here's where I need to be careful, because whole life insurance isn't always a bad product. It has legitimate use cases. If you're young, you want a small death benefit to cover final expenses, and you value the forced savings aspect. A modest whole life policy can be reasonable. The death benefit is guaranteed. The premiums are fixed, and there's something to be said for simplicity. But whole life insurance as a retirement investment for people in their 50s and 60s, that's where the math gets ugly. Robert bought a whole life policy at age 57. The agent showed him illustrations with cash value growing to over $200,000 by the time he turned 75. The death benefit was $350,000. The premiums were $840 per month, $10,080 per year. The pitch was that he'd have a tax-free retirement supplement he could borrow against, plus a death benefit for his heirs. Here's what the illustrations didn't emphasize. The cash value in the early years is tiny. Robert's policy would take roughly 12 years just to break even, meaning the cash value wouldn't exceed what he'd paid in premiums until he was 69 years old. And that break-even point assumes the policy's dividends perform as illustrated, which they may not. By year 10 of the policy, Robert will have paid over $100,000 in premiums. The cash value might be $60,000. The difference went to commissions, administrative costs, insurance charges, and the insurer's profit margin. He's essentially paying for insurance protection he may not need while funding a savings vehicle that's dramatically underperforming alternatives. The tax-free loan feature that gets pitched, it's real, but it's not free. When you borrow against your cash value, you're charged interest. The current rate on many policies is around 5 to 6%. Yes, you're borrowing your own money and paying interest for the privilege. Some policies offset this with dividends, but the net effect is still a cost. And if you die with an outstanding loan, the death benefit is reduced by the amount you borrowed. Wealthy retirees keep their insurance and their investing separate. If they need death benefit protection, they buy term insurance, which is dramatically cheaper for the same coverage amount, and invest the difference. If they don't need death benefit protection because their kids are grown and their spouse has other assets, they skip insurance altogether and let their portfolio do the work. Robert's $840 per month, invested in a low-cost index fund averaging 7% annually, would have grown to over $220,000 after 15 years. And he would have had access to that money at any time for any reason with no surrender charges, no loan interest, and no insurance company taking its cut. Instead, he's locked into a product that benefits the company more than it benefits him. The mental trap here is the word insurance. Insurance sounds safe, insurance sounds prudent, but whole life insurance isn't primarily insurance. It's a hybrid product that does two things poorly instead of one thing well. It's expensive insurance paired with an underperforming savings account, wrapped in tax advantages that mostly benefit people who've already maxed out every other option. Asset number 4, rental properties that don't pencil out. This one gets people upset. Owning rental property is a religion for some. Real estate always goes up. Renters pay your mortgage. You build equity while someone else pays the bills. I've heard all of it. And in some cases it's true. But I've also seen too many retirees sitting on assets that generate pathetic returns while dominating their mental bandwidth. Take Susan. She lives in Texas. She inherited a property in California from her parents, a modest 3-bedroom house in a decent but not exceptional neighborhood. She decided to keep it as a rental. The property is worth about $600,000. She has a mortgage of $50,000. So her equity is $550,000. The house rents for $2,600 per month. That's $31,200 in annual gross rent. Here's the expense breakdown. Property taxes, $5,200. Insurance, $1,800. Property management, 7% of rent, so roughly $2,200. Maintenance and repairs budget, about $3,000 per year on average, though some years it's much higher. Vacancy allowance, 1 month per year average, so $2,600. The mortgage payment is small, about $450 per month, but that's mostly principal now. After all expenses, Susan's net income is around $15,000 per year on $550,000 of equity. That's a return of 2.7%. She could get more than that in a high-yield savings account with zero effort. Now, Susan will tell you about the tax benefits, depreciation, expense deductions, all of it. And those are real. But depreciation just defers taxes you pay them when you sell through depreciation recapture. And the expense deductions only matter if you're generating actual income to deduct against. The fundamental problem is that her capital is trapped in an asset returning 2.7%. Let's run an alternative scenario. Susan sells the property. After transaction costs and capital gains taxes, and yes, she'd owe taxes because the property's basis stepped up to market value when she inherited it. So no built-in gains from inheritance, but there's appreciation since then. Let's say she walks away with $500,000 net at a conservative 4% withdrawal rate. That's $20,000 per year. At 5%, it's $25,000. Both figures are higher than the $15,000 she's currently netting from the rental. She'd make more money with less capital and zero phone calls about broken garbage disposals. The psychological trap here is identity. Susan sees herself as a property owner, someone with a real asset, something tangible. Stocks feel abstract. Property feels solid. But that emotional attachment masks the actual economics. She's got $550,000 earning 2.7% when it could be earning 7 or 8% in a diversified portfolio. And she's spending hours each month dealing with a property manager who isn't that responsive and tenants who occasionally don't pay on time. This isn't an argument against all rental real estate. If you bought at the right price, if your property generates a real cap rate of 6% or higher, if you have reliable management in place, and if you've run the math honestly, including reserves for major repairs, rental property can work. But a lot of retirees are sitting on properties they inherited or bought years ago that have appreciated significantly, but now generate terrible yields relative to the equity trapped in them. The past returns aren't the current returns. The equity is real, but it's working against them. Wealthy retirees treat real estate like a business, or they don't do it at all. They run the cap rate math. They compare returns to alternatives. They're not emotionally attached to any individual property. And if they want real estate exposure, they often get it through REITs, real estate investment trusts, which provide diversification, professional management, liquidity, and none of the 2 a.m. phone calls about burst pipes. I've seen the argument that rental property provides inflation protection. It can. Rents rise over time. But so do property taxes, insurance, maintenance costs, and everything else. And if you're in a rent-controlled jurisdiction, your inflation protection is capped by law. The inflation hedge argument is real, but often overstated by people who want to justify keeping a property they should have sold years ago. The pattern across these 4 assets, timeshares, high-fee annuities, whole life insurance as a retirement vehicle, and underperforming rental properties, is that each one is sold as an asset, but functions as a liability. Each one locks you in, charges you ongoing fees, and benefits the seller more than the buyer. Each one exploits an emotional vulnerability, the desire for guaranteed memories, guaranteed income, guaranteed safety, or the status of property ownership. The math tells a different story than the sales pitch. So far, we've covered 4 assets that drain you slowly. Now let's talk about the ones that can wipe you out fast. The slow leaks are insidious because they're easy to ignore. A few percentage points here, an annual fee there, a maintenance cost that creeps up 3 or 4% per year. You don't notice the water level dropping until you're suddenly wondering why the bucket feels light. But the next 4 assets, they're not slow leaks. They're the holes that open up when you're not looking. The ones that can drain half your savings in a single market cycle. And they're sold with the same confident handshakes and glossy brochures as everything else. Asset number 5, high yield bonds, or what the industry politely calls junk. Walter retired in 2018 with a portfolio of about $800,000. He'd been a conservative investor most of his life. CDs, treasury bonds, the occasional dividend stock. But interest rates had been near zero for years. His CDs were paying 1.2%. His treasuries were barely keeping up with inflation. His financial advisor suggested he look at high-yield corporate bonds. Safe companies paying 6 or 7%, he was told. Not exciting, but steady income. Walter didn't understand that junk bond isn't an insult. It's a credit rating. These are bonds issued by companies with credit ratings below investment grade BB, or lower from Standard & Poor's, BA, or lower from Moody's. The companies have meaningful default risk. The higher yield exists precisely because there's a higher chance you don't get your money back. Walter allocated $300,000 to a high-yield bond fund. For the first 2 years, everything looked fine. He received his monthly interest payments. The NAV fluctuated a bit, but nothing alarming. Then came March 2020. The high-yield bond market dropped about 20% in a matter of weeks. Companies whose debt Walter owned, airlines, energy companies, retailers, were suddenly facing bankruptcy. The steady income he was counting on became uncertain income, and his principal was evaporating. The cruel irony of high-yield bonds is timing. Defaults don't happen randomly. They cluster during economic downturns, exactly when retirees need their income most. The same recession that's crushing your stock portfolio is also crushing your high-yield bond portfolio. The diversification you thought you had, it disappears precisely when you need it. Walter's fund recovered eventually. High-yield bonds often do. But Walter was 72 years old during that drop. He didn't have time to wait for recovery. He was taking withdrawals to fund his life. Sequence of returns risk is brutal enough with stocks. Adding high-yield bonds to the mix doesn't solve it, it amplifies it. Here's the math that matters. From 2010 to 2020, high-yield bonds returned about 6.3% annually on average. Sounds reasonable. But that includes the recovery from the 2008 crisis. During the crisis itself, high-yield bonds lost over 25%. And that's the index actively managed high-yield funds often did worse because they had to sell into a falling market to meet redemptions. The proper role of bonds in a retiree's portfolio is safety and stability. Short duration, high-quality bonds, investment-grade corporates, treasuries, agency mortgages. You accept lower yields because you're paying for predictability. You want bonds to be the portion of your portfolio that doesn't fall apart when everything else does. If you need growth, that's what stocks are for. Don't make bonds behave like stocks. It doesn't work. And the people selling you high-yield bonds as safe income aren't the ones holding the bag when defaults cluster. Wealthy retirees understand the purpose of each asset class. Stocks for growth, high-quality bonds for stability, cash for emergencies. They don't chase yield in the wrong places because they've done the math on what a 5% additional yield is worth if it comes with a 20% chance of principal impairment at the worst possible moment. Asset number 6, structured products. The marketing materials always say the same thing. Market participation with downside protection. Capture upside while limiting risk. Best of both worlds. If something sounds like it's giving you the benefits of stocks without the volatility and the safety of bonds without the low returns, you should ask who's paying for that magic. Gerald's advisor recommended a structured note linked to the S&P 500. The pitch was straightforward. If the market goes up over 5 years, you participate in the gains up to a cap of 40%. If the market goes down, you're protected from the first 15% of losses. The advisor called it sleep well at night investing. Gerald was 63, 5 years from his planned retirement. 5 years of protection while staying invested sounded perfect. Here's what Gerald didn't fully grasp. The 40% cap meant that if the market went up 60% over those 5 years, which it actually did from 2011 to 2016, Gerald would miss out on the extra 20%. The protection on the downside wasn't free. It was paid for by capping his upside. He was essentially buying an expensive insurance policy he didn't need, sold to him wrapped in complexity that made it hard to compare to alternatives. The fees embedded in structured products are often opaque. There's the issuer's markup, the cost of the derivatives used to create the payoff structure, and the commission paid to the advisor. These costs compound. By some estimates, structured products underperform simpler alternatives by 2 to 3% annually on average. Not because the math is impossible, but because every layer of engineering adds a layer of cost. There's also the matter of liquidity. Gerald's structured note had a 5-year term. If he needed the money in year 3, he'd have to sell in a secondary market that barely exists, likely at a significant discount. The protection he bought only applies if he holds to maturity. Life doesn't always cooperate with 5-year lockups. The complexity test I use is simple. If I can't explain how an investment works in 3 sentences, the person selling it understands it better than I do. And that's not a position I want to be in. Structured products routinely fail this test. Try explaining a reverse convertible note or a principal protected note to someone in 3 sentences without leaving out crucial details about caps, triggers, and credit risk. You can't. Wealthy retirees tend to avoid financial products that require a 40-page prospectus to understand. They accept that market volatility is the price of growth. They don't try to engineer it away with products that transfer upside to the issuer and leave them locked in. If they want downside protection, they buy it directly through asset allocation, through high-quality bonds, through cash reserves. They don't wrap it inside a product that obscures what they're actually paying. Let me do a quick aside on reading the prospectus. The structured product Gerald bought came with documentation. It's only 400 pages. Half of them are definitions of words you already know. Payment at maturity, observation dates, underlying asset. Then there's a section describing what happens in various scenarios that reads like it was written by lawyers trying to make sure you never actually understand what you bought. By page 200, you've forgotten why you started reading. By page 400, you're just signing whatever they put in front of you because you want to go home. That's not an accident. Complexity is a feature, not a bug. It obscures the transfer of wealth from your account to the issuers. Asset number 7, vacation homes. Margaret and Tom bought a cabin in Colorado in 2007. They'd been renting there for years, always the same week in August. The idea of owning their own place, somewhere the grandkids could visit, somewhere they could escape the Texas summer heat, felt like the retirement dream. They paid $420,000, put 20% down, financed the rest, figured they'd rent it out when they weren't using it to cover the mortgage. The math looked reasonable on paper. The mortgage was about $2,000 per month. Property taxes were $4,000 annually. Insurance, another $1,500. Utilities, even when the place sat empty, ran about $250 per month. HOA fees, $1,200 per year. Maintenance budget, they figured $5,000 per year. Then reality intervened. The ski season rentals they'd counted on, competitive market, and their property manager took 30% off the top. The summer rentals, they wanted to use the cabin themselves during prime weeks, which cut into the best rental income. A pipe burst in winter when they'd failed to properly winterize. $14,000 in damage, and the insurance claim was denied because they hadn't used a licensed plumber for the shutoff process. A tree fell on the driveway. Another $3,000 for removal and grading. 8 years in, they'd spent roughly $400,000 on the cabin between the down payment, mortgage payments, taxes, insurance, maintenance, repairs, and property management. And that's not counting the travel costs to get there and the time they spent coordinating repairs. They'd used the cabin an average of 3 weeks per year. Some years, they only made it up twice. Life got busy. The grandkids had camp and sports and didn't want to spend a week in the mountains with no Wi-Fi. The dream of family gatherings faded into the reality of scheduled conflicts. Margaret ran the numbers one evening. 3 weeks per year for 8 years, 24 weeks total. $400,000 divided by 24 weeks is about $16,500 per week of usage. She could have stayed at the Ritz-Carlton in Bachelor Gulch for less, and she wouldn't have spent a single hour on the phone with a plumber in Denver. The psychological trap with vacation homes is what behavioral economists call projection bias. You imagine your future self will want exactly what your current self wants. You'll want to spend 3 weeks at the cabin every summer. You'll want to host family gatherings. You'll want to escape the heat. What actually happens is life, health issues, grandkids who prefer video games to hiking, spouses who don't love the same places you do, a flight that's more exhausting than you anticipated. The cabin becomes an obligation rather than an escape. Wealthy retirees rent. They rent exactly the property they want in exactly the location they want for exactly the week they want it. No property taxes, no burst pipes, no calls from the property manager about a bear breaking into the garage, no mortgage interest, no HOA meetings. Their money stays liquid and working in their portfolio. The question I always ask people considering a vacation home purchase: what else could this money be doing? $420,000 at 5% is $21,000 per year. That's 2 months at a very nice rental anywhere in the country with no maintenance calls, no property taxes, and no commitment to return to the same place year after year. The flexibility is worth more than the equity. Asset number 8, actively managed mutual funds. This one is the quietest wealth destroyer of all. It doesn't announce itself. There's no dramatic story about a market crash or a plumbing disaster. It's just a slow, steady erosion that happens inside your portfolio, invisible until you run the numbers. David has a 401k from his years at a manufacturing company. He rolled it into an IRA when he retired. The balance is about $600,000. His advisor has him in a mix of actively managed funds, large cap growth, small cap value, international equity, and a bond fund. The weighted average expense ratio across these funds is about 1.4%. David's advisor tells him these funds are worth the fee because they outperform. The problem is that they mostly don't. Over any 15-year period, roughly 80 to 90% of actively managed funds underperform their benchmark after fees. The ones that outperform in one period rarely repeat in the next. It's not impossible to find winning active managers. It's just incredibly difficult, and the evidence suggests that past performance is essentially useless for identifying future winners. But let's set aside the outperformance question for a moment. Let's just look at the fee drag. 1.4% doesn't sound like much. It's $1,400 per 100,000. On David's 600,000, that's $8,400 per year in embedded fees. Over a 20-year retirement, assuming the portfolio doesn't grow, that's $168,000 in fees alone. But the real cost is compound. If David's portfolio averaged 7% gross return before fees, his net return after 1.4% is 5.6%. Over 20 years, that 1.4% annual fee reduces his ending wealth by roughly 35% compared to a zero-fee alternative. No zero-fee alternatives exist, of course, but low-cost index funds charge 0.03 to 0.1%. The difference between 1.4% and 0.05%, call it 1.35%, sounds small. Over 20 years, that difference can erase 30 to 40% of ending wealth. Let me make this concrete with some math. $600,000 invested for 20 years at 7% grows to approximately $2,318,000. At 5.6%, which is a 7% minus David's 1.4% fee, it grows to approximately $1,764,000. The difference is $554,000. The fee didn't just cost David his annual expense ratio. It cost him over $500,000 in ending wealth. And that's before you factor in the transaction costs, bid-ask spreads, and tax inefficiency that often accompany actively managed funds. The most honest assessment comes from Warren Buffett, who bet $1 million that a low-cost S&P 500 index fund would outperform a collection of hedge funds over 10 years. He won handily. The hedge funds couldn't overcome their fee structure. If the smartest, most sophisticated active managers in the world can't beat a simple index fund after fees, what are the odds that your advisor's fund picks will? Wealthy retirees use low-cost index funds, not because they're exciting, and not because they guarantee the best returns in any given year, because they reliably capture market returns with minimal drag. They're tax efficient, they're transparent. You can explain exactly what you own in one sentence. An S&P 500 index fund owns a proportional slice of the 500 largest companies in America. Done. No prospectus required. If you're finding value in this, hit subscribe. I put out videos every week breaking down exactly this kind of thing, the mechanics of wealth destruction and wealth building that most financial advice ignores because it doesn't sell products. Let me bring this all together with a realistic scenario. Imagine two people, same age, same income history, same savings. Both earned $80,000 annually during their working years. Both retire at 65 with $1.2 million. They've both done the hard part. They've saved consistently for decades. Now let's see what happens to their retirements based on which assets they chose. Retiree A went the poor retiree route. She bought a timeshare for $15,000 in her 50s, paying maintenance fees that escalated to $1,400 annually by retirement. She put $200,000 into a variable annuity with a 7-year surrender period and embedded fees of 2.3%. She owns a whole life policy she was sold at 55, still paying $8,000 annually in premiums, with cash value that won't break even for another 6 years. She has a rental property with $400,000 in equity, generating $11,000 net annually, a 2.75% return. She allocated another $200,000 to high-yield bonds for income, picking up an extra 1.5% in yield, but adding significant risk to the bond portion of her portfolio. She has $100,000 in structured notes, with a 5-year lockup capping her upside. She bought a vacation condo for $280,000 that she uses 3 weeks per year and spends $12,000 annually on carrying costs. And her remaining investable assets are in actively managed funds with an average expense ratio of 1.3%. What does her retirement income look like? The annuity generates income but locked up her principal. The whole life policy is still a net outflow. The rental property requires constant attention for a subpar yield. The timeshare is a pure drain. The high yield bonds are adding risk to a portfolio that should have bonds as a stabilizer. The structured notes are illiquid with capped upside. The vacation home is a money pit. And the active funds are bleeding her returns by over 1% annually. Her $1.2 million net of all the holes she's drilled is generating maybe $35,000 in sustainable income with significant risk and ongoing obligations. Add Social Security, and she's probably fine for basics, but she's not comfortable. She's managing a portfolio of products rather than living her life. Retiree B took the wealthy retiree approach. She has no timeshare. She rents vacation properties when she wants them, spending about $5,000 per year on nice trips and keeping her capital invested. No annuity. She created guaranteed income through Social Security optimization and keeps her other assets in liquid, low-cost investments. She bought term insurance in her working years and dropped it when she retired, no ongoing premiums. No rental property. She invests in REITs for real estate exposure, earning a diversified yield of about 4.5% with 0 property management calls. Her bonds are high quality, short duration, doing their job as portfolio ballast. Her stocks are in low-cost index funds with an average expense ratio of 0.06%. No structured products, no vacation home, no complexity. Her $1.2 million is generating roughly $50,000 in sustainable income at a 4% withdrawal rate, with the flexibility to adjust no lockups, no surrender charges, no phone calls about plumbing, add Social Security, and she's comfortable. She spends her time volunteering, traveling, seeing grandkids, not managing a portfolio of obligations. same savings, same working income. A $50,000 difference in annual retirement income, driven almost entirely by which assets they chose to hold. Retiree A drilled holes in her bucket. Retiree B kept the water where it belongs. The 8 assets we've covered aren't random. They share 4 common traits. First, complexity that benefits sellers. Every one of these products requires an expert to explain, a brochure to make sense of, a licensed professional to sell. Complexity obscures costs. It hides who's really benefiting. If a product is hard to explain, the person selling it is usually the winner. Second, lockups that eliminate flexibility. Timeshare contracts, annuity surrender periods, whole life premium commitments, structured product maturity dates, vacation, home carrying costs. All of these take money that could be moved elsewhere and trap it. Wealthy retirees value optionality. They keep their money liquid and working. Third, fees that compound against you. A 1% fee sounds small. Over 30 years, it can eat a quarter of your ending wealth. Embedded fees in annuities, active funds, and structured products compound invisibly. The more complex the product, the more places fees hide. Fourth, emotional narratives that override math. Memories, guaranteed income, safety, ownership, status, dreams. These aren't bad things to want, but when they're used to sell products that don't deliver, they're weapons. The best financial decisions are made with a calculator, not a story. 3 practical takeaways. 1. Run every opportunity through the leaky bucket test. Is this asset adding water to your bucket, or is it drilling another hole? Be honest about ongoing costs, lockups, embedded fees, and opportunity costs. If it's a hole, it doesn't matter how good the brochure looks. 2. The complexity test. If you can't explain the investment in 3 sentences to someone who knows nothing about finance, the person selling it understands it better than you do. That's not a good position to be in. The best investments are often the simplest. 3. Ask what your money could be doing instead. Every dollar in a timeshare is a dollar not in your portfolio. Every dollar locked in an annuity surrender period is a dollar you can't reallocate. Every dollar of equity in an underperforming rental property is a dollar not earning market returns. Opportunity cost is invisible but real. Wealthy retirees optimize for optionality, simplicity, and returns that compound rather than fees that compound. Lazy investing built more fortune than crypto memes. The people who've done best didn't find magic products. They avoided the holes that everyone else keeps drilling.